Yo, what's going on? This is Give and Grow. Welcome back to the show. My name is Ryan, and this is Eric.
What's up? What's up?
Yep. We're going to be trying some new things today. I definitely want to make this show a bit more engaging for y'all and just something that you can be able to go through and just see some of the new things that we got. So I want to start off the show today by talking about something that we learned just overall this past week. It can be finance or like anything related. I think that would be something good, just to share some new information. You know what I mean? Something that I learned this week. It's actually in light of our topic today, the F.I.R.E. movement, which we're going to be getting into in just a little bit. But I learned that part of the F.I.R.E. movement is that they aim to have 25 times their annual expenses in retirement. 25 times.
Wait, break that down to me.
So 25 times means, let's say your annual expenses was like, I don't know, like $50,000.
Okay.
So you multiply that by like 25. So roughly it would be around like 1.3, 1.4 mil.
That's going to give you your number for you to reach financial independence, retire early.
Right. So that's something that I've learned, which 25 seems like, cool. Yeah, 25 that's a lot. Like, but it makes sense though. They utilize the 4% rule. So they aim for 25 times their annual expenses, and then they do the 4% rule, which means every year, basically they withdraw 4% from their account. It's like a safeguard because you don't want to take out too much. So
you don't want to run out.
The amount will never run out if you only take 4%, theoretically.
So, like, let's just say your number was $1 million. You're going by the 4% rule. You could live off basically $40K a year.
Right.
And the rest would just continue to be reinvested.
Great. But yeah, that's what I learned this week. What about you?
I've learned a lot this week. I've actually been reading The Snowball by Warren Buffett for the second time, but I'm doing an audio book this time, and it's just little things I'm catching I didn't catch the first time just because my knowledge has increased. Something else I learned is that GDP came in kind of low this week. I think it came in at like 1.6%. So yeah. That was pretty interesting. And then lastly, I've been reading a good book about the different cycles in markets, and I just finished a chapter about the credit cycle, and I think we are currently at the top of the credit cycle right now, which is very interesting going forward. We now have high interest rates and high inflation. So those are really the three big things I kind of learned this week. What's
going to come after in the credit cycle? Like if we're at the top, what does that mean going forward after that?
Well, not to put fear out there, but typically there is a lot of credit driven events. Because of the increased interest rates, as Buffett says, you see who's been out at shore without out a swimsuit when the tide comes in. So basically, you have a lot of increases in bankruptcies, not only in banks, through real estate, just people in their individual investments, like everyday people like us. So yeah, a lot of defaults, and eventually it causes the reset.
It's funny how you started out before you went into the things that you learned by saying, I'm not trying to spread doom. And then you talked about three things regarding potentially some very, very bad situations. But if y'all haven't watched any of our content, if you think that we're like insanely bearish, it's not about being bearish. It's just seeing what's going on just in general in the economy. And some things that have happened historically that result in some pretty catastrophic events are starting to come up. But, we're not telling you to load up your puts. We're not telling you to sell all your assets and go into cash. And for one, we're not financial advisors.
No. We don't have a crystal ball.
We're trying to tell y'all what just, we're seeing. So if y'all get that vibe, we're not trying to spread the fear.
Yeah. It's just food for thought, Yeah, we're looking at information. We're looking at data. We're studying other investors. And we're just giving our take on it. There's a lot of different takes. And, one of my favorite quotes is, the market will remain irrational longer than you can say solvent.
That's a very bearish statement, I would say so.
That is.
So he's a doomer. He's a doomer.
I'm not a
I think he's a doomer. I'm just kidding.
Maybe I am. Maybe we'll
are.
see. We'll find out.
If y'all learned anything this week, we would love to be able to hear from y'all, talk about those things. Help us learn. The whole point of all of this is to be able to have this community where we can be able to share ideas and talk about different things and continue to educate each other, because knowledge is power. That's always going to be one of the biggest things to me, and we definitely want to be something out there that can be able to provide some level of good stuff to talk about. So
yes, sir, absolutely.
But yeah, with that being said, we are going to get into our topic for today, which is the FIRE movement. So FIRE it's this acronym, Financial Independence, Retire Early. And I'm not really sure when this started to come about. I want to say it started to come about maybe like the mid 2010s is when I started to hear about it. It might have come maybe earlier than that. But basically, it's not only the idea that you want to retire early, but it's like the strategy in which you do it. So I'm just going to just share some information here about the FIRE movement. They try to go by the rule of 25, which means that they want to have 25 times their annual expenses. So that's one thing. I also mentioned too that they want to go by the 4% rule. Mm-hmm. For actually pulling money from those savings slash investments to be able to live off every single year. It says here that the FIRE movement prioritizes saving and investing 50% or more of your income so that you can retire early. People that do the FIRE movement drastically reduce their expenses, and then they also seek ways to increase their income and then heavily invest.
I love it.
Yeah, which basically sounds great just for like anything outside of FIRE. But FIRE people are really they're really trying to build that like big nest egg so that they can like leave their traditional job.
They're driven.
Right. They're very driven. You can say that a lot of them are just gazelle and intensive on trying to get as much as they can.
Are you technically on the FIRE movement?
You can say that. You can say that I'm on the FIRE movement, but I'm not like I don't really say that like, oh yeah, I'm FIRE and try to make that a part of my like personality. I think a lot of people that like are in the FIRE movement, they're very like, that's all that they talk about is like, oh yeah, it's like I'm gonna retire early. It's like FIRE movement.
It's like their CrossFit.
Yeah. It's a part of their personality.
I gotcha.
Basically what it is. It says here too that it's popular among millennials.
Of course.
But because of its strict expense cuts, it may not be for everyone. I want to talk just a little bit about the fact that it says it's popular among millennials. And I think that this is something that we talked about before, about the different generations and how when you basically are growing up under one generation, what they teach and probably try to educate you,
instill,
instill, that might have worked for them, but it might not work for you going into the future. And there's a bunch of like different factors that kind of play into that. So for example, if your dad was a boomer and he's trying to give you boomer advice, it might not work for you, in today's climate. It just, it might not, because what was going on with them back in the day, might be a lot different than it is now. Like back in the day, you can be able to have just like one income and you can be able to buy a home and support your family. And that's very, very rare these days.
Yeah, you're right. Times have changed for sure.
Yeah, times have changed.
I think another big difference is, when you think about millennials, they're kind of in the golden information age. So you have so much information that's available to you through podcasts, through YouTube, audiobooks, everything. And if you go through that, if you go through all that education and you give yourself that understanding, you might feel, but you might say that's the path I want to go down. Mm-hmm. Whereas because when you think about the boomers, they were influenced by a generation that came out of the Great Depression. So, right. Their parents had given them a certain outlook on the stock market, investing, retirement. And then, the boomers were they're kind of known as like the hard workers. And honestly, over the last 40 years, if you invested in the market and you did real estate, you're probably doing pretty well right now. So yeah, they definitely have their own point of views. But yeah, I can see how millennials have their point of views as well, because they have so much more information available, and it's not, they're not just getting, from their parent or their environment. They have the whole internet. They can, it's coming from everywhere. So yeah, I'm not surprised by that.
What do you think about the FIRE movement in general?
I like it. The first time I was introduced to it was actually on YouTube. Mm-hmm. I can't remember the exact name of the channel, but it was really cool how the family broke it down. I think they both had government jobs. They ended up saving a lot of money, like you said, maybe even higher than 50% saving rate. They ended up going to Portugal, where it was just a lower cost of living, and they still do their YouTube videos, and sort of their education. I think that's really cool. I mean, they're still doing meaningful work. When I first got married, obviously my wife and I were on the same page when it came to finances, but I had to find a happy medium. Whereas I would have thought that it would have been cool to try something like that, but my wife wasn't necessarily all about that, and that's okay. It's not for everybody, because you are only young once, and it's just, like I said, it's just not for everybody. But I really admire the people that do it and that pull it off. I think it's a cool thing. I really do.
Yeah, I agree. You asked me if I was FIRE. I guess I kind of am. So my retirement age that I would like to retire by, the latest, is like 50 years old. Obviously, if I can do it earlier than that, then that'll be great. But it's going to take a lot of work. It's going to take a lot of effort, and something that I feel very, very blessed with is that my wife is on the same page as me. Not in terms of like FIRE, but in terms of like, there's a lot of things that we don't really need, and we can be able to like build assets and really, really budget and put stuff away. But at the same time, we can be able to still enjoy our lives. And I think that's something with the FIRE movement that, specifically with like couples, you kind of have our perspectives here, but if you're not at the very least kind of on the same level as far as it goes, it's probably not gonna, FIRE might not work out for you, because, you have one that's like, they might be like really, really intense FIRE movement, and the other one is probably like, I want to spend everything that I can.
Yeah. Do you think that a common misconception with FIRE is that every day is going to be like Saturday? Do you think that's what drives a lot of people to wanting it?
I think freedom is probably the thing that drives them. So kind of, yeah. But something that I think is important is a lot of them realize that they're probably still going to continue to be frugal and maintain the same lifestyle that they had, but they just don't have to work anymore. So, we talked about like the rule of 25 and the rule of 4%. So I feel like a lot of FIRE movement people are like, I can be able to retire when I have X amount of like dollars, but I know that I'm not going to go past that 4%, because they value the freedom more than being able to spend a lot of money. Now, obviously, if they were to like get more money, they, that number, that 4% increases a lot. But I think that for a lot of them, they're just trying to get the freedom.
We were talking earlier about allocation for the FIRE movement, but I think kind of just thinking about it, I think you kind of have to be 100% in stocks. If you're assuming the 10% return and you're taking 4% out, well, I don't know, because I mean, if the rest were in bonds, I guess technically you could still have like a 1 to 2% return.
Yeah,
I guess it just depends, but I don't know. But have you seen any information about that as far as like the actual allocation that people typically have once they are in FIRE? Do they stay completely in equities? Or
I didn't really see a lot of information on their allocations, but I would say that a lot of them are like, okay, well, I'm trying to, I have like a target date fund, or they're like all in like the S&P, but it kind of like when you get up there to, especially when you get like upwards of like 750, a million, 1.5 mil, you're definitely probably decreasing the amount of risk as much as you can, because the power of numbers lets you be able to make a pretty decent amount.
Well, let me ask you this: if you let's pretend you hit FIRE, how are you doing your allocation the next day?
Let me just go over some of the things that I would like to have before I retire.
Okay.
So I would like to have my house paid off.
Okay.
And I would like to have around like 1.5 mil.
Okay.
In total. Now, I've kind of been leaning towards the house not being paid off a little more these days, but at least have it be like the majority of it paid off. You know what I'm saying? So and I think that around 50 is when I can probably be able to achieve that. So when I think about my allocations, really it's going to depend on what's going on. We're trying to work on our like active investing. We're trying to work on like our joint, having like multiple streams of like cash flow. I probably don't need to touch the 1.5. From the 1.5, I'm hoping that that's going to come from like Roth IRAs and Roth 401ks, right?
Okay.
So not only am I going to have that, but I'm also going to have, our joint, which is going to be pretty much actively invested and stuff like that, plus a lot of other things. So,
any real estate?
Maybe. I'm not
other than your house?
Sure. Maybe.
Possibly.
I'm not. Yeah, possibly.
We'll see.
So, we talked about it before, but it's gonna be very, very diverse, because I'm gonna have my assets from my like actual retirement accounts. Those are probably going to end up being very, very safe. Like I'm thinking, index funds, maybe bonds, dividend stocks. I'm going to be pretty interested
Dividend stocks, yeah.
Yeah. But we'll get into all that later. And then probably more of like the active money is probably what I'm gonna try to be like living on. I have an account right now where I'm basically putting extra checks and my bonus checks into.
Okay.
And also my like play money, whenever I get play money in our budget, that's going to be there. So if I can get that up to like $300K and just actively invest that every single year.
Now, when you say actively, you talk about selling options.
Yeah, selling options, and maybe just like going into like growth stocks. Okay. Trying to learn to do more of that stuff. For me, it's like I want that to be one part, and then we're gonna have our joint, and then I want to have this thing, and real estate might be a thing.
Yes, sir.
Obviously, crypto. Big crypto boy over here. We're trying to make stacks.
Wait, me or you?
No, not me.
Okay.
I mean, well,
Can I push back on one thing?
Yeah, go ahead.
That 1.5 million number that you have right now, is that inflation adjusted?
No, it's just 1.5 mil.
Okay. Are you not concerned that your expenses today that you're going by might be a little bit higher based off inflation in the next, I'm just saying, 15 years?
Well, that's assuming inflation is not going to be handled in 15 years, which I think it's going to get handled.
Right. What I'm saying, but their target's still 2%. So once you compound that yearly, wouldn't that increase the amount that you need for your expenses?
Yeah, but it's not going to be, well, I'm still going to be living below my means. Because here's the reality. Inflation can be 15%. But if I'm saving a lot of money, really it's not, really right. It doesn't really matter.
But if your expenses increase, like let's say instead of it being...
let's say it goes from like 3,000 to like 4,000. But I'm still saving 50% of my income, not counting.
Well, right, but would you still pull out 4%, or would you have to increase it up to 5% because of the inflation?
Probably be pulling from retirement accounts, probably the same, because I would rather adjust my living situation than be like, oh well, I need to like pull out more. Because here's the thing is that I'm probably not going to be living too large whenever I retire. I can be downsizing, or if we have like a paid off home, most of my expenses are probably going to be going to like house stuff, which if I have a paid off home, that's probably not going to matter. So it's going to be like, okay, food, gas, but I mean, unless inflation is like 200% at some point, if it gets up there, I don't really see it being like a huge issue, but obviously, you know, something that like is important for sure is changing the amount I take out depending on what's happening in the, you know, in like the markets. Cause like, you know, I'm not going to take 4% out if we're in like a down market. Like that's going to be something that I'll probably be just like considering a little more. What do you think? Because you said that you want to have like 3 million in assets before
inflation adjusted. Yeah.
But like, how do you adjust for that though? Because you'll be constantly adjusting it over time.
I don't know the exact formula how this is done, but I'm just really giving myself a margin of safety. If I'm doing, let's say I have 3 million invested. Let's just, for math purposes, it's all in the S&P 500. So 10% of that would be 300K a year, but I'm not going to be pulling that whole 300K. If I'm going by the 4% rule, then I'm looking more at 120K a year. That's 30, 69, 120. So yeah, inflation adjusted, I think that would be, because that's roughly what I make right now. But like you were saying, other expenses will hopefully be gone, like the house.
Right.
And then obviously, I'm not having to throw that huge percentage into investments because now I kind of have my nest egg.
Right.
And that's to a certain point. So yeah, so I'm looking at it more as, you know, how much a year would I like to feel comfortable for me and my spouse, and just living the life that we want to live. And for me right now,
he wants to live large.
No, 120K is not that big of a deal to me, especially in 30 years, inflation adjusted.
I think that the biggest thing about the FIRE movement is just the thought that you can make a reality of something that probably wasn't really available for like a lot of people.
And also, if you go through all the frugalness when you're young, I mean, do you really want to keep that same, like, you should always be frugal and live below your means, but don't you want to be able to like kind of do a couple more things?
Yeah. You scale up, but but you can scale up depending on your assets. But it's like, we might just have different value systems because, like, you know, let's say you wanted to like go on like 20 vacations in like a year or something like that and spend like $20,000 each time. I mean, if that's what you're doing, that's fine. But
I want to go to the lake, you know, go to the beach a little bit, you know, maybe take a trip to Europe every now and then, but nothing crazy. You know, I still want to be able to enjoy what I've worked so hard to build up. You know what I mean?
Yeah. And plus too, by that time, you're probably not going to be worried too much about, like what you're saying, putting money away for investing, because now it's like, okay, I'm here.
Right.
So now the income that I get, I just like, okay, well, what do I do with this? Mm-hmm. Because for me, I'm like, man, if I was getting like $10,000 a month, and then after my expenses, I had like, I don't know, $8,000 to spend in a month. I don't even know what I can even spend that on. I mean, I could spend it on like something.
You might be spending it on groceries.
Well, no, I'm probably not. Nah,
that's just why you got to give that margin of safety.
Oh yeah.
For inflation.
I mean, yeah. I'm not telling you that that's like too much, but like, I think something.
Well, I'm telling you, I think you need more.
I need more. 1.5 mil. So let's say I made 10% on 1.5 mil a year.
Okay.
That's what, $150,000 a year?
Yeah.
That's a lot of money.
But you're not pulling that whole 10%. You're only pulling 60K.
Okay, 60K, but my house is paid off. Like if I were to take the rent
in the year 2045, 2050, you're assuming a lot of things, and you always teach me, you know, don't assume.
Yeah. I mean, I guess.
I just think it's interesting. I mean, this is something we're obviously going to grow and expand on.
If the amount of money is going to scale up, let's say like 120,000 now, in like 20 years is actually 60,000. And yeah, so if everything keeps on expanding and like everything gets overinflated, then yeah, I can definitely see how I would probably need more in that case.
It's just food for thought. I mean, it's something you got plenty of time. We both have plenty of time to think about this, but that's why we have these conversations to push back.
Right.
You know.
Well, that's the thing too, is that pretty much the FIRE movement gives people an opportunity to like get out of what the culture back in the day was definitely saying. Now, do I think that people put too much effort into being countercultural with like, oh, well, I don't need to go to school or I don't need to get educated. I just need to just listen to people on YouTube like us and and like do what they do. Or, you know, they're like, oh, well, yeah, the government's going to take care of me. It's no problem. I'm just going to just do whatever I want. Like, I think people lean into those things a little too much, but I do think that there's a chance that people can be able to really work hard and not feel that they have to work until they're dead. Something that we talked about earlier was life after fire. And you were talking about this thing that you saw where a lot of people left their job because they were, you know, they were in the FIRE movement. They basically didn't like their life afterwards.
Yeah, it wasn't this every day is a Saturday kind of life. You know, you wake up on Monday and you're like, oh, let's go, but you realize everybody's at work or everybody's doing this, you know. So I think it's important to really have a good system in place when you get to that point and to really be thinking about it. You know, what are you going to do for your health during those times? You know, are you going to go on walks, you know, bike rides, you know, what are you and your spouse have planned to do, you know, throughout the week? And also, when we talk about, you know, the amount of allocation that you need to do these things, that has to be considered as well. You know, what's going to continue to give you meaning and purpose, you know, and I think for you continuing to do stuff like this and education, but other people, it might be completely different things. But if you don't consider that, and you just see the money and then every day is a Saturday, you might be a little surprised. It's not everything that you thought it was going to be. So you really got to consider all those things. Life
after fire, you definitely need to have this level of understanding that you're going to have a lot of time.
Yeah.
And the time that you have, you should put towards things that are constructive, that are, you know, it's just something that, you know, your passion work and just stuff like that, because you might do it for like a couple of years and you're like, man, like, you know, maybe this wasn't right for me in the first place. Like, you know, maybe I should have kept working, but I would never get bored of doing stuff outside of my traditional job. Like, you know, if I got to wake up, make YouTube videos, talk to you about finance, you know, doing all of my like trading stuff and learning about the economy, I can do that all day.
Heck yeah.
I can do that literally all day. But, you know, a lot of people, they don't think about things after FIRE because they're not really thinking about it now. You know, like what you're saying, they only think about like, oh, well, I got to reach this level so I can stop working. But then it's like, okay, well, what are you going to do after work?
Yeah.
You know, what are you going to do?
How are you still going to find meaning and purpose in your day?
Right.
For me, it's going to be meeting you at Cracker Barrel, you know, every day for breakfast.
Cracker Barrel. No. I love it.
Eat some pancakes.
We should franchise one.
Let's do it.
I wanted to end our time on the Grow Show with our financial question of the week. So I'm going to give this one, but going forward, I want y'all to leave in the comments some questions that y'all would like us to answer from y'all on this show. I'm really looking forward to being able to have some more engagement with y'all. Like, if y'all want us to like talk about anything, or if y'all have any questions, leave them down in the comments. The financial question that I have for this week: what are some things that you actively try to cut from your budget to save money?
That I actively try to cut from my budget to save money? Definitely eating out when I don't need to. Instead of getting the more expensive gas, I try to go to Kroger as much as possible. When I leave the gym, I used to have a bad habit of always going to Smoothie King and getting like a big smoothie. I told you, I used to always go to Sprouts and get, you know, ribeye steaks. Now I'm shopping at Aldi's. So yeah, it's really groceries as much as I can on gas. And I used to have I wouldn't say it's a bad habit because I think I value knowledge and education, but I used to buy Kindle books like anytime I wanted to, no matter what. And so now I only allow myself to buy like one a month. And that's been working because I'm making myself finish the one that I buy because I view it differently now. Whereas before, if I'm not really into it, I kind of just put it to the side, buy another one. But now it's just once a month, and I'm probably going to finish that book because I spent money on it, and that was my book for the month.
Yeah.
But yeah, those are the three big things. Anything you got on that?
Well, how much do you think that you've saved so far starting this process?
Since we've been doing this?
Yes, since you started the budget, how much do you think that you've saved? Because I mean, I know Smoothie King, You're talking like $7 to $10 a smoothie.
Well, I
and
think
you
also
said that you spent like $25 a day at Sprouts.
Yeah, I think the groceries and all that, I'd say anywhere from $200 to $300 a month at least.
That's a lot.
Yeah, heck yeah.
And that's just from like cutting out just some of those things. For me, food is one. I know that this past week, just something that like happened to me. We have this like vending machine at work, and I'm just like, man, like, I'm getting like the smart popcorn. It's like $1.50, and if we just bought from the store just like a box of like bag popcorn that can last us a month for like $15, instead of like buying all these things every single day. It's a small thing, but it definitely adds up. Yeah, for me, groceries is probably still that thing, but I combine a lot of things in our grocery budget. So it's not just food. It's also like toiletries and cleaning supplies, everything for Riley, our cat. So I'm actually spending a lot less on like actual food. So maybe I'm like teetering that line a little too much, but it might, I don't know. I like saving money. So whether it's reducing the amount of times we like eat out, or reducing the amount of times that I like drive somewhere. I definitely want to have an episode in the future where we talk about like money hacks or like things we do to like save money, because I got some pretty funny ones that I might be able to have on there. But yeah, that's gonna be it for that. Let us know in the comments for that question. What are some things that you actively try to cut from your budget to save money? That's going to be our financial question of the week. Let us know in the comments for the next one. That's going to be the Growth Show for this week. Do you have anything else you want to say?
I just want to say thank you for that information, Ryan Buffett. It was great. It was great.
I wish I was more like Ryan Buffet, because I'm starving.
Well, you look great, man.
I appreciate it.
But I think that's going to do it for today, man. That was awesome. Guys, until next time, let's continue to give and grow.